CAPM and beta factors. Hi guys, let's start our discussion with beta factors and CAPM model, capital asset pricing model. Now, I don't want to make this session very theoretical. Like I don't want you to feel like we are just learning something from the textbook or we are just learning something from a material. I want you to really experience how these things work, how betas work, what is risk, what is systematic, what is unsystematic, what is CAPM model, what is the logic behind that, how is the formula derived, everything. I want you to be having a bigger picture about what are the aspects that we are covering in this particular lecture. Okay, I want you to be having a practical approach towards this. So I'll not talk about anything. I'll not give you any topic introduction or anything. I'll just start with a scenario and let's see how each topic pans out as we move forward with the discussion. Okay, chalo. So as you can see on your screen here, there is a given scenario that so we have some capital with us, and what they have given is the possibility of oil price. What is it? The possibility of oil price increasing, staying at an average level, or reducing. Okay, the possibility of the oil prices increasing, being at an average level, or falling down. The chances for high level of oil prices is 25%, average level is 50%, and low level of oil prices is 25%. Okay, so what does that mean? In simple language, there is 25% chance that the oil prices will increase, 50% chances that oil prices will not change, they'll stay at the average level, and another 25% chances that the oil prices will drop in the market. This is the likelihood, the probability of the given scenario. Okay, now you have two options with you. What is that, sir? Either with your capital that you are having, you can purchase shares of an oil company like BPCL or like ONGC or something, which directly or indirectly relates to oil production and oil prices. Okay, BPCL, Bharat Petroleum Corporation Limited. Now, whenever there is a surge in the oil prices, usually if that prices of oil, if the increase in the oil prices is because of increase in taxation, duties, or charges or customs, etc., then company share price will not take any much of a big hit, because that additional amount goes to the government. For example, Indian students can easily understand this. For example, if the oil prices per liter of petroleum has increased from 75 to 78, so per liter there is a 3 rupees increase, right? Okay, so if this 3 rupees increase is because of the bare price, if the price of the oil itself is increasing, that's good for the company. Okay, but if this 3 rupees addition is because of customs, excise duty, or GST or something like that, obviously GST is not applied, but regarding other taxes or charges, in that case, that amount will go to the government. So company's share price will not be much affected. Coming back to our point of discussion here, assuming that the increase is in the bare price of petroleum, sales price of petroleum, not the cost of the crude oil. I'm talking about increase in sale price of petroleum. So if sale price of petroleum is increasing, isn't that good for the company that is selling oil? Yes, sir. So if something is good for the company that is selling oil, then wouldn't that increase its profits? Yes, sir. If profits increase, wealth also increase. Yes, sir. Net worth increase. Yes, sir. Stock prices increase. Yes, sir. Correct? So basically the summary is that if the oil prices are increasing, then your share price also will increase. Clear? Yes or no? Right. Now, if you have invested in the shares of an oil company like BPCL and the petrol prices have increased, now what will happen? The share price also will increase. Yes, sir. Very good for me, sir. Sir, I purchased the shares of a company and the share price is increasing, sir. Very good, sir. Yes, sir. Yes, happy. But the chances of that happening is only 25%. Okay, sir. And if the petroleum prices are not increasing, 50% chances there that petroleum prices will stay at the average level. So in that case, okay, no problem, sir. But then again, if you have purchased the shares of a oil company, there is 25% chances that oil price will reduce. Oil price will reduce. Okay. Now see the annual returns column of annual returns column of oil company ma. So if the prices are increasing, if the if the oil prices are increasing, an oil company will have an increase in the share price, so they'll get 25% annual returns. Similarly, if the share price, if the oil price is at an average level, you'll have only 10% profits. But if the share price is reduced, where they have 25% chances that the oil prices will be reduced, you will run into a loss of -5%. You'll run into a loss of -5%. And the expected return, we have been doing expected values since your childhood, right? In ACCA, expected values are calculated in F5, F7, F8, F9, SBR. Everywhere we calculated expected value, probability into the given value. So 25% of 25%, 50% of 10%, 25% of -5%. So if you do it, you will get 10% ma. You can do it according to your convenience. If you are not comfortable, you can calculate and do it. 25% of 25, 50% of 10, and 25% of -5. So sum it up, you will get 10%. Okay. And think carefully, think carefully. If there is another company which is purchasing oil for its consumption purpose. Okay, let's say you are Ola or else you are Uber, and the oil prices are increasing. Sir, diesel, petrol, whatever it is. Oil prices are increasing and you are running a car fleet company. You are running a transport agency. Now, this is a negative factor for your company, isn't it? The raw material or the consumption prices are increasing. Your inward supplies are increasing in cost. So this is an additional cost for your company which will reduce your profits, isn't it? Yes. Okay. So if the oil prices are increasing for people who are running Ola, Uber and all, for them the profits will reduce. They have an inverse relationship. So if you see here, if the oil prices are high, 25%, Ola, Uber, they get -5% returns. Sir, they gave airline company here. Same thing now. For airlines, crude oil, aviation fuel is the raw material. I took a different example of Ola, Uber or whatever it is. You just understand the relationship now. So if the oil prices are increasing, an airline company's stock should reduce because it uses that oil at a higher price. Similarly, if it is staying at an average level, they get 10%. If the prices are reducing, if the input cost is reduced, your profits will increase. So they are getting 25% returns. Okay, see, technically here -5, here -5, here 25, here 25. So, sir, basically what they're trying to do is, in this example, in real life, it won't happen like this. You don't have exact equal values here. This is just a hypothetical example to give you a picture, a clear picture. Okay, sir. Accepted. Understood, sir. Now, let's say you have invested $100,000 in your hand and you have invested entire 100,000 in the oil company. Entire 100,000 in oil company. Okay, sir. Excellent, sir. Okay. If the oil prices are raising, staying at an average level or reducing. Okay. So if the oil prices are raising, you will get how much return? 25% return, sir. Excellent. Shabash, shabash. Okay. Cool. Got it. So how much will be your return? 25,000. If the oil prices are staying at the same level, you will get 10%. That is 10,000 return. Or else if the oil price is dropping, you will get a loss of $5,000. Okay, sir. Accepted, sir. Understood, sir. So here if you think carefully, you are exposing yourself to a risk of variable returns. To a risk of variable returns. Sir, what is risk of variable return here? See, your profit can be either 25,000 or your profit can be only 5,000. Sorry, actually a loss of 5,000. There are chances that you can get a profit of as high as 25, or a loss of 5,000 is also possible if the oil prices are dropping down. Okay, the same thing happens with an airline company. If the oil prices are increasing, they get a loss of 5,000 or a profit of 10,000 or a profit of 25,000 if oil prices are dropping. Now imagine what you have done is, you have invested 10,000, out of 100,000, you have put 50,000 in oil company shares and 50,000 in the airline company shares. 50,000 in oil company, 50,000 in airline company. So let's see what happens in that case. 50,000 in oil company and 50,000 in airline company. So in this case, what happens is, if you see carefully, first, if the prices are increasing, if oil prices are increasing, you get 25% return in the investment in oil. So 25% of 50,000, that is 12,500 you will get here. But in airline, you will get a loss of 5%. 5% of 50,000 is 2,500 loss you will get. Correct? Okay, sir. Next one. If there is average prices, then 10% return. So here you will get 5,000. Here you will get 5,000. Okay, sir. Accepted. In the third case, minus 5 plus 25. Okay, so here you will get minus 2,500, or you can get plus 12,500. Okay, see, if you see carefully, what is your total return in any case? Whether oil prices are increasing, whether oil prices are average, or whether oil prices are dropping down, if you have divested your portfolio, sir, what? If you have divested your portfolio, if you have purchased some shares of oil company and some shares of airline company, so you have a what do you call it, a portfolio of reverse companies. If one is increasing, the other decreases. If one is decreasing, other increases. So you have shares which go in a negative trend with each other, in an opposite trend with each other. So basically, if you see here, first case total profit is 12,500 minus 2,500, 10,000. Second case 5,000 plus 5,000, 10,000. Third case minus 2.5 or plus 12.5, again 10,000. So no matter what happens with the oil price, your overall profit is fixed at 10%. Yes or no? This, my dear friends, is called as advantage of having a portfolio distribution. Advantages of having a portfolio distribution. Sir, what do you mean by portfolio distribution? It means that instead of putting all your eggs in one basket, if you distribute your eggs into multiple baskets, even if some of them go bad, the others can be used. Simple, ma. You are going in a bus. Okay, you are carrying, let's say, 10,000 bucks. So if you put all your 10,000 bucks in a purse or in a wallet and keep it on you, and if somebody steals that, you're gone. Your entire 10,000 is gone, and you may be left with no money to, whatever it is, go back home or whatever it is. But imagine, instead of putting all the 10,000 in one place of wallet or a purse or whatever it is, if you have distributed that in front pocket something, in back pocket something, in your bag something, in a wallet something, whatever it is, if you have distributed it into multiple areas, even if something goes wrong, you might have something left with you. So that is the effect of portfolio distribution. Even if you invest in a company stock also, distribute that, diversify your portfolio, so that even if something goes wrong, you have other aspects to take care. Got it? Clear? Okay. So if you feel overwhelmed, take a break here. Okay. It won't be possible for me to break this thing into multiple pieces. Okay. Because these are basic topics, ma. I can't just split this thing into 10 minutes, 20 minutes videos. That won't be appropriate. So I'll continue the lecture. You guys take a pause here if you need. Okay, just pause the screen, take a small break and come back and resume it. Next one, systematic risk, beta factor. Okay. Sir, what do we mean by risk, first of all? Everybody keeps saying risk, 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 risk and risk. So what exactly do we mean by the word risk here? Okay, so risk in simple language, in your 7th or what do you call it, say F7 or F5, you might have learnt about this concept of risk. What exactly do we mean by risk, sir? Risk is variability in returns. What is it? Variability in returns means if the returns are changing, or if there is a probability of higher returns, lower returns, increase, decrease, if there is variability, that is called as risk, and you can measure a risk, you can calculate a risk, or you can say that there is 30% chances, or there are 40% chances, 50% chances. You can actually calculate or measure or quantify a risk. That is called as risk here. Now, this overall risk with relation to financial management, overall risk with respect to financial management is distributed or covered into two kinds of risk. What are those? One is called as a systematic risk and the other one is called as unsystematic risk. Systematic risk and unsystematic risk. You guys might have learned that systematic risk is the risk that is faced by an organization with correlation with the market. Unsystematic risks are not directly matched with the market factors and other stuff. I don't want to teach you like that. I don't want my AFM students to just by heart a concept. I want you to practically experience it. So give me a second, I'll show you with practical example, right? Okay. So before we see with the practical example, just I'll give you a quick understanding about what is systematic, what is unsystematic. Then I'll show you with the practical examples. Okay. So first of all, systematic risk. What exactly do we mean by systematic risk, sir? System. The entire system of markets will be having the same kind of impact. Okay, that means in another language, it is affecting the industry or it is affecting the market as a whole, not just one specific company. It affects the market as a whole. So systematic risk cannot be avoided by diversifying into multiple stocks. Okay, so what does that mean? See, in this example, what you have done is there is a risk that the oil prices might increase or decrease. So what you have done, you have divested that into oil companies and airline companies so that no matter what happens with oil price, your overall return will be fixed at 10%. So you diversified to mitigate the risk. This is an example of unsystematic risk. See, oil prices increasing or decreasing is unsystematic because it will impact only the respective companies. It will not impact the entire market. So that is unsystematic. If a risk is limited only to selected stocks or selected industries, that is unsystematic risk. If a risk relates to entire market as a whole, which cannot be avoided by diversification, that is called systematic risk. So you can see this chart on your screen. The total risk is equal to unsystematic risk plus systematic risk. Unsystematic and systematic. So you can see here, this is the unsystematic risk curve. This curve which is going downwards, this is the unsystematic risk. Sir, why is it going downwards? Because you are increasing number of securities. What are you doing? You are increasing the number of securities. So if you are putting more and more diversification, so the overall risk will keep reducing because all the shares will not be getting impacted. Even if some bad news comes, only one stock will fall, remaining stocks might increase. So your overall risk will come down when you have multiple portfolios, okay, or multiple stocks in your portfolio. And then your systematic risk, which is the green color one. So the systematic risk will always be there in the market. If the market is crashing, your stocks also will crash. Okay, not always required, but if it is a systematic risk, then in that case, this is unavoidable. No matter how many stocks you increase, your portfolio will always be affected by the market. Okay, so to show you systematic risk, I have already opened multiple charts on my browser. So I'll just switch to full screen and I'll switch to full screen mode in this as well. I hope you are able to see the chart clearly. This is the maximum zoom. I can't zoom in much than this. It will just make this entire thing clumsy. So let me just keep it like this. Okay, so now you can see on your screen here, just a second, let me confirm. Yeah, now you can see on your screen, this is a chart of Nifty 50. Okay, see here where the Nifty 50. Okay, it is showing Bollinger Bands. Okay, don't worry. This is Nifty. Nifty is what? One of the index of Indian stock markets. It is the index for National Stock Exchange. And Sensex is the index for Bombay Stock Exchange, BSE, NSE. We'll talk more about this when we discuss about the markets. So let's stick to the point of discussion here. So this is an year till date chart. That means from January of 2020 till date. So how Nifty, the index is moving, whether it is increasing or decreasing, the chart is here. I would like to pay a complete attention to month of March and April. In between April and March, that is specifically on March 23rd and 24th, when lockdown was announced across the country due to COVID-19. So I'll just zoom in to March 23rd and 24th. Yes. Okay. So you can see here 24th March. Okay. Yeah. The opening was at 7,848. highest was 8036.95, closing was 7801, and the lowest was 7511. Okay, sir, what are you saying? So from where are you seeing all that information? I'll do one thing. I'll just take a snip of this and I'll copy it to our class notes so that you guys may be able to get a bigger picture. Yes, I have just copied the screenshot to our class notes so that you guys can even refer to this later. So you can see here on the top here, this part, yes, here. Opening, O stands for opening, that is 7848.3 points. Then highest was 8036, lowest was 7511 points. Okay, so 7511, and I want you to pay attention to this candle. Okay, we call these as candles. So this point is the lowest point, and you can see the market dropping since last 1 week here. The entire Nifty, the index was completely on the lower side. It is dropping. Now let's move on to another chart here. Okay, so what is this? This is ICICI Bank. Okay, so this is ICICI Bank stock. So let me just scroll it down and copy that also to our class notes so that you will get this as reference. Okay, so this is also copied. Let me just zoom it, resize it a little. Okay, so what is, oh, I did not zoom it to April. Okay, let me just delete this then. Let's zoom this to April. Yes, yes, this is what we need exactly. Okay, so here also you can see ICICI as well, right? So same pattern, same pattern. However, our market was falling for the last 7 days. It is also falling here, and this on 24th of April, you can see here, this is the lowest point again. And after that, again the reversal started. A slight bit of update was there, slowly recovered, and then again lockdown was made strict. Again there was a drop. Slowly it started recovering. Okay, but again you can see the pattern here. This pattern is what I want you to identify, the downwards pattern. Okay, so the entire market was also crashing. You can see the charts are looking literally similar. Okay, here also you can see there is an increasing pattern and then again decrease and then again going up. Here also you can see same pattern. It was dropping, then again it was increasing, again it started declining. See, both the index and the stock are moving in the same directions. This is what I want you to identify. Okay, both index and the stock is moving in the same direction. Okay, sir. Now let's move on to another chart. Okay, what is this? This is, oh, my favorite, Badshah, Reliance. Okay, let's see. Reliance is my favorite stock, like the love of my life. Okay. See, again, sir, again, same pattern, again. It is coming down for a 1 week time. Again, it started increasing. Then again, there are red candles. Again, dropped for a few days. And again, it is inclining. So this trend is what I want you to observe. Again, here, the lowest was on 24th of March. See this candle, 24th. Yes, 24th of March. Here it is the lowest. And then similarly, I'll choose one more. And I'm not taking screenshot for this because I established the pattern for you. This is Dr. Reddy Laboratories. So this also, you can see here, I'll scroll to March, April. Yes. Okay, I'll just reduce the indicators that I'm using here so that you guys can get a better picture of the graph. These are all market indicators, RSI band, MACD, and volume bands. This we use for decision making in stock markets. This is my live trading account. Okay, I'm recording this lecture on a Saturday so that this charts don't keep up and down, moving up and down. So I'm doing this recording on a Saturday. Okay, so again you can see downward pattern for an entire week, and on 24th it started rising. This stock is on the lowest at 23rd, not on 24th. Lowest was on 23rd. Other stocks lowest was on 24th. Happens. But again you can see the same pattern, downwards, then slowly started moving up. Again there was some downward pattern and then again started moving up. Okay, and I'll just give you a glimpse of how stock markets fluctuate here. We'll learn more in the respective chapters, but on its lowest day, it was at 2,497. Let's round it up to 2,500. 2,500 is its lowest on March. Okay, today we are recording this lecture in the month of September. So let me just show you the current stock price. See, this current stock price is 5,100. This is after continuous crash for the last 1 week. So before that, before the crash started, the stock price has crossed 5,500. 2,500 to 5,500 in less than 6 months. That is more than double of your investment. Okay, so it all depends on what kind of stocks you pick and on at what point you have actually started investing. You might be saying that, sir, then stock market is very good for investment. Let me show you that as well. See, if you have actually invested at this point at 5,500 range, current market price is 5,100. So you have lost 400 bucks in what? In 4 days, on 18th to 25th. Yeah, exactly 7 days. In 7 days, you have lost 400 bucks per share. So it all depends at what price you entered, at what kind of movement you entered, what happened in the company after you entered. There are lots of considerations. Okay. I hope you guys got the picture about systematic risk. When the market is fluctuating, when the market is crashing, or when the market is rising, your stocks also will rise or drop irrespective of their nature. They will definitely sync with the market. So that no matter what you diversify, no matter how much you invest in number of shares, your entire portfolio will also move up and down along with the market. That is called as systematic risk. I hope it is clear for you all. Systematic risk is clear. Yes, shares or the stocks or investments will also fluctuate along with the market, but not necessarily in the same weight, in the same rate, in the same pattern. Sir, what does that mean? See, if Nifty has dropped, if the entire market has dropped by 10%, doesn't mean your stock also will drop by exactly 10%. Sir, what? Nifty, the entire market has crashed. It has reduced by 10%. Okay, sir, what do you mean by that? Okay, I'll just show you here. See here, Nifty 50, 11,050 it is, 2.26% change is there. That means the market has increased by 2.26% on a given day. Okay, and now if you see ICICI on the same day is also increased, but the percentage is different. Market increased by 2.26%, ICICI stock increased by 3.86%, and similarly if you see S-Bank has increased by 3.09%. SBI cards was dropped by 0.50%. Okay, you can see that different stocks are raising or falling by different percentages. Look at ICICI. This is not ICICI stock. Okay, this is call option 360 rupees October expiry call option. We'll discuss in option pricing. Don't worry, let's not talk about that today. Okay, this is ICICI stock which increased by 3.86 when the Nifty increased only by 2.26%. Similarly, on the same given day, okay, this is also in the banking stocks. Okay, let me just show you another chart. Yeah, this makes more sense. This is also a different part, and you can see here Nifty increased by 2.26% and Cipla has increased by 5%. 5% here. Data Red increased only by 2%, less than 2%. Oroforma 3.5. So like this, basically different stocks fluctuate at different rates. Okay, that is what I wanted to explain to you guys. Okay, systematic risk means both market and the stocks will move in the same direction but need not be with the same magnitude. One may be 3%, other may be 8%. Okay, that relationship is called as beta. I hope now you guys are getting the picture here. That relationship between market and the security. Okay, so can you explain? I'll try to just give you a glimpse of that, not absolutely correct, ma. I'm not giving you complete calculation and all. I'm just giving you a picture. Okay, see, if I calculate beta factor for ICICI, let's say for ICICI, see here, Nifty increased by 2.26%. So change in market is how much here? 2.26%. whereas the underlying security has changed by how much? 3.86. 3.86. So I can say that the beta, the relationship is 3.86 divided by 2.26. That means how much will that be? Somewhere around 1 point something. 3.86 divided by 2.26, that's 1.71 roughly. 1.71. This is what, sir? This is the beta factor of ICICI on that given day, at that given moment, on that point, at that point of time. But usually what we do is we take this over a series of days, like maybe 30 days, 60 days, 90 days, we will calculate and then we will identify the beta factor of that particular stock. I took only 1 day's change. Okay, on that particular day, 2.26 and 3.86 I took. Instead of that, you can do this for multiple days over a span of 60-90 days and then calculate an average change. Okay, again, standard deviations and all that stuff also you can use. I'm just giving you a glimpse of how to identify the beta factor. Okay, and let me just show you that as well. ICICI. Where are you? SMAs and EMAs are given. Weighted average. Okay. And B momentum. Okay. I can't find the beta factor here. No, beta factors are not there. Chalo. Yep, not here. Not available here in this. Again, I'll have to research for that and figure it out. Directly, it is not available within my trading platform. No issue. I hope you guys got a picture about what is beta factor, how the markets change, how the markets are volatile, how they are playing, and the relationship between the stock market versus the particular selected stock is called as beta factor. I hope all of this is clear. Okay, sir. Next what, sir? Next is simple unsystematic risk. So simple. Even if the market is crashing, some stocks will increase. Even if market is rising, some stocks will fall. That is called unsystematic risk. So if I make it easy and clear for you, systematic risk is market-wide. Unsystematic risk is specific risk to that particular company or sometimes that particular industry. When the entire market is rising, only few banking stocks may fall or only telecom stocks may fall. That is absolutely possible. That is called unsystematic risk. Whereas systematic means entire market will either rise or fall. Okay, variability can be a positive variability or a negative variability. There could be positive risk, negative risk. Absolutely cool. Clear? All good, ma? Very good. Chalo, let's go further. So before we move forward, let me show you another example of market risk, systematic risk. So here you can see on 3rd September, I want you to identify this. 3rd September, Nifty was at 11,600, almost all 11,591 was the day highest. 11,585, yeah, 11,585 was the day highest, almost 11,600. From 3rd September, 4th, 5th, 6th, 7th and 8th September, it came to as close as 11,300, even less than that. 11,290 was the lowest. So what was the reason for this drop of 300 points, sir? 11,600 to 11,300 approximately. So there was a crash of almost all 300 points in Nifty. Why was this happening? Because there were tensions in Indian-China border. Okay, at this LOC, line of control, there was a war kind of tension between the India and China. Because of that, the markets has taken a hit from 11,600 to 11,300. 300 points of drop was there in Nifty. And at the same dates, same timings, from 3rd March to 9th March, 3rd September to 9th September, you can see here, this is my favorite stock, Reliance again, was at, this is ICICI, yeah. It was at 392.5, 392 roughly. From there, 3rd, 4th, 5th, 6th, 7th, 8th. On 8th, it came to as low as 370. From 393 to 370. That's again a crazy drop in ICICI as well. Again, same happened with Reliance also. You can see here, 3rd September, it was at its highest of 2145. 2138, yeah, 2138. It came to as low as how much? 2077. from 2138 to 2050, yeah, 2047 actually. So again, that's another 30-40 points of drop is there in Reliance as well. So basically, when the entire market is crashing, the stocks are also crashing. This is called what? This is called market risk. Sir, you are only talking about negative risk, sir. Show us some positive risk as well. Okay, not completely true, but I'll just show you a simple glimpse, because it will take some more time. We have just started. The recap was just started. The rebound just started. So if this recording was done 2-3 days later, I could have shown you better picture. But see here, Nifty 50 on 18th of September. 18th of September, it dropped from 11,600 to 10,800. 11,600 to 10,800. That's 800 points drop over a span of 1, 2, 3, 4, 5 days, 5 trading days. Okay. Again, same reasons, market tensions, COVID. There was news that number of COVID cases are increasing, and there is a chance of second lockdown in UK. And also Trump has said that he will not be leaving the country peacefully if he doesn't get re-elected. That means it's not like that. He said that I will not be transferring the control to somebody else peacefully. That is what he said. Because of various reasons, again, market started crashing here, and again it started rebounding on 25th of September, which is a Friday 25th of September. And Saturday and Sunday are holidays, so we don't have these trading sessions. Once this is done, we might be able to show you that as well. But you can see here, continuous drop and then a rebound. Again, for ICICI as well, I'll just go to last 5 days. Yeah, you can see continuous drop and then again rebound yesterday. Yesterday, rebound happened. And Reliance also, I can show you the same thing. See, continuous drop and then rebound started yesterday. Okay, so basically this is how markets systematic risk works. Okay. Chalo, with that being said, I hope I have covered all the topics except for CAPM. So take a break and we'll continue with CAPM model. Okay. Make sure to take a break. After that, come back with a fresh set of brain, mind, and then we'll start the CAPM model. Okay. So before we move on to capital asset pricing model, first let me ask you a small, let me make it very clear for you, a small topic, that is beta. Beta is what? Beta is the relationship between the stock and the market, isn't it? We discussed this beta as the relationship between the market and that particular security. In case of ICICI, we calculated for a given day, the beta factor was 1.71%. Okay, sir, accepted. Now, please understand, if the beta is more than 1, that means it is very sensitive to the market now. It is very sensitive to the market. So in this case, when market raised only by 2.26%, ICICI changed by 3.86%. So that means ICICI is more sensitive towards the market changes. Okay, that's why your beta is more than 1. On the other hand, beta equal to 1 implies, that means exactly along with the market it is moving. If market increases, this also increased by 1%. If market decreased by 1%, stock also decreased by 1%. Okay, this is a situation where it is perfectly positioned with the market. Okay, on the other hand, if your beta is less than 1, it means it is relatively less sensitive. It is relatively less sensitive. And now comes a very tricky point which is not covered in your books. That is, if beta is negative, what, sir? Is it possible for a company to have a negative beta? I bet you guys, you will not be able to find out this answer in any textbook. No matter what textbook you check, whether it is Kaplan, whether it is BPP, you search, you will not find this. Sir, can a beta be negative? Absolutely yes. Absolutely yes. Theoretically, absolutely yes. Sir, practically, I don't think it is possible. Sir, sir, this is bad game. This is not in good faith. Understand, logically understand. Beta is negative means what, ma? If market is increasing, your stock is decreasing. If market is falling, your stock is increasing. Isn't that what negative beta means? Your stock is reversely or inversely related with the market. Tell me what kind of stocks can be like that. You figure out and tell me. I haven't seen a single stock that moves exactly in the opposite direction of a market till date. I have been involved with stock markets for the last 10 to 12 years, I guess. I have never seen a single stock moving exactly opposite to the market. So theoretically, it is possible for a stock to have a negative beta factor. Usually, not absolutely correct. I can say that with 40 to 50% of the times, commodity prices are inversely proportional or inversely related with the stock markets. Like if the stock market is increasing, gold value decreases, gold or silver. These commodities usually decline, but if the market is crashing, this value usually increases. But if it is an overall crash of economy, then everything will fall down. That is why I'm saying you cannot practically figure out any stock or any commodity, any security which is exactly inversely moving with relation to the market which has a negative beta. Not possible. Theoretically, yes, it could be there. Okay, on any given day there could be a negative beta. On a given day when the market is raising, also some stocks will fall. If you choose to calculate beta only for that particular day, it could be negative, but it is not like that. Beta is calculated after considering average periods. Okay, chalo, with that being said, now let's move on. Capital asset pricing model. I won't take much time here because I don't want to beat around the bush too much, so I'll directly go to the formula. What is the formula, sir? Required return. Okay, required return for a stockholder, required return of shareholder will become what now? We already discussed cost of equity. Cost of equity for a company will be equal to the return expected by the shareholder, correct? Yes, sir. We denote cost of equity as what? KE. Okay, chalo. So, KE, capital asset pricing model, suggests that KE, cost of equity, can be calculated as RF plus beta into RM minus RF. Sir, what is this formula, sir? Okay, very easy, very simple. Don't try to by heart it. Use your non-existing brain. Open your fridge door and take out that brain. There is no point of putting your brain in the fridge. Take it out, keep it inside your head, and start using it. Okay? There is no point in saving your brain for something else. This is something that students do. They use their brain in something that they are not supposed to, and they use their entire brain over there, so they have nothing left for studies. So don't do that. See, in simple language, switch on your brain now. In simple language, what is RF, sir? RF stands for risk-free return. Risk-free return, sir. What instrument will give me a risk-free return? You guys tell me. What kind of instrument will give me a return without any kind of risk? The best security with zero risk. Nothing. Nothing. There is no single instrument that comes with zero risk. But we use gilt securities. What? We use gilt. G-I-L-T means what, sir? Government securities. Okay, you have RBI bonds, you have central government bonds, postal bonds, etc., etc. These are issued directly by the government. Treasury stocks, sorry, not treasury stocks. What is it called? The treasury bills or something. I'm unable to recall the name. But usually the central bank of the country will issue these kind of instruments, or the central government of the country will directly issue these kind of instruments. So they are assumed to be risk-free. They are assumed to be risk-free. Okay, all hail democracy. But if there comes a day when some country goes into again monarchy, and that particular monarch says that no, all the previous contracts or all the previous promises made by the past government is gone, then your bond becomes zero. Even there also there is a risk, but the chances of that happening is very less, right? So that's why we assume that gilt securities are absolutely risk-free. Okay, sir, imagine, use your brain. If a government security, if a bond issued by the Reserve Bank of India is giving you 6% return, 6% return, you give 100, I'll give you 106 after a year. Okay, sir, accepted. and there is another private bank, let's say RBL, okay, Ratnakar Bank Limited, or else S Bank, or else ICICI, or some other bank. Some other bank is saying that we will also give you 6%. Which one will you choose? Will you choose the government issued bond or will you choose the private bank issued bond, sir? Obviously government, sir. Private banks, so I can't trust. Today it will be 300, tomorrow it will be 30. I can't trust. But RBI or else central government bonds, I can trust them. Okay, accepted. Now the private bank is giving you a slight incentive. The private bank is saying that, okay, we understand you. Okay, we feel you. So, okay, your bank, your central bank or your central government is giving you 6%. We will give you 8%. We'll give you 2% what? 2% premium. Why are you giving me 2% premium? Because you are taking a risk. Instead of investing in a safe bond, instead of investing in a risk-free, you are taking some amount of risk and you want some return in exchange. So you take a risk, I'll give you a premium for taking that risk. What is that premium, sir? Bond is giving you 6, we will give you 8. So 2% extra is our premium towards the risk that you are taking. Yes, sir. Understood, sir. But the problem here is, what if the prices fluctuate? We have this beta factor also. Now, if the market is crashing, the company's returns also crash along with the market. There is a direct correlation between the stock prices and the stock market, right? How do we measure that correlation? With the help of beta factor, sir? Yes, correct. So now visualize the formula, ma. What is RF, sir? RF is what the Reserve Bank of India is paying me. How much? 6%, sir. Yes, accepted. Beta, what is the beta of ICICI from our previous example? 1.71. Okay, keep it aside. Keep it aside. How much is the market paying me? What? How much is the market paying me? Not ICICI. I'm not talking about ICICI. I'm talking about the market rate of return. Overall market. If overall market is, let's say, is paying 8%. Overall market is paying 8%. Return on normal marketable instruments. Normally in the market we get 8% return, okay? But RBI is giving you 6%. So you still have a market premium of 2%. That is market premium, not your company's return. Not your company's return, ma'am. Market is giving 8%. RBI is giving 6%. You need to give how much? That is what we are calculating. Since your company is highly volatile, your company is having a beta of 1.71, the shareholder of your company is not happy even if you give him, the shareholder of your company is not happy even if you give him this 2% premium. He's saying that, okay, 2% premium is offered by the market. Market is giving me 2% extra, but your company is having high volatility, right? Your company needs to pay me better returns than market, because if market crash by 1%, your company is dropping by 1.71%. You are more riskier than market. So I won't be accepting if you give me only this 2%. I want you to give me more than that. How much, sir? That is 1.71 into 2%. Understood or not? If market is ready to pay me 2% premium for taking a risk, if your beta, if your volatility is much higher than the market, you need to pay me more than that. If your beta is 2, you need to pay me 2 times of 2. You need to pay me 4% premium over the market, over the risk-free. Able to understand now? If your beta is 5, for example, 5 times, you are very highly volatile. So in that case, 5 into 2, 10% premium plus 6% offered by RBI. I want 16% from your company. Clear with CAPM model? What is that? Risk-free plus a premium which is offered by the market, but that is market premium. So I want much higher than that based on your beta. If your beta is less, if your beta is only 0.5, that means you are safer than the market. Even if market crashes by 1%, your company will fall only by 0.5%. So I am happy even if you pay me only 1% premium, not 2% premium. Now clear? Okay. Chalo. So this RM minus RF is what, ma? Market premium. What is this? Market premium. And this beta is your volatility factor, okay, or your correlation compared to the overall market return. So let's see this small question, and after that we'll discuss the limitations of CAPM model. That is very small topic, hardly takes 1 minute per point. Okay, what is this? The company has a beta of 1.5. The market premium for the risk is 4% and the risk-free rate is 2%. So what is our formula, ma? RF plus beta into RM minus RF. Okay, so they gave you RF is how much? 2% is the risk-free return plus beta is 1.5 multiplied by RM minus RF. See, they gave you the entire market premium, not the market rate of return. So RM minus RF is calculated as 4%. So 1.5 into 4%, that is 6% plus 2% total. 8% is your risk required return from this particular company, or else the cost of equity for this particular company, KE, is 8%. Clear? Shall we move further? Okay. Now look at the limitations. Now, what are the limitations, sir? First of all, the first and foremost limitation is estimating the market return. See, for calculating what is this CAPM model, cost of equity, you need RM. So how do you calculate return from market, sir? Okay, stock market moves up, down, up, down, up, down. How will you calculate the returns? Okay, that is a problem. See, this is estimated by considering movements in the stock market as a whole over a time. How much time? Again, that's a point. So this will overstate the returns achieved because it will not pick up the firms that have failed and have dropped out of the stock market. Sir, what does that mean, sir? Okay, for this, for you to understand this point, you need to say, you need to consider some things. See, when we calculate the market return, which market shall I take? Shall I take overall market, all the companies listed in the market, or should I take an index of that market like Nifty or like Sensex or like Dow or like Nasdaq? So should I consider the entire market or should I only take the indexes from that market? Okay, so that is the first point. And there could be some companies which are getting added into that index, some companies which get removed from the index. So how do I calculate exactly the return? That's always a problem. Okay, and then estimating the beta factor. Again, how do you calculate your beta? I have already showed you that if you take only 1 day, it could be 1.7, and if you take 5 days, it could be different. If you take 100 days, it could be different. Beta values are historical and will not give an accurate measure of the risk if the firm is having recently changed its gearing or its strategy. Again, this is a very important point. What does it mean, sir? See, for example, to calculate beta, I have to consider past changes in market and past changes in my stock. What if today we have appointed a new CEO and this guy is crazy good? He's better than Sundar Pichai. Okay, so now you tell me, will the past track record beta to be considered for the future actions of this CEO? Obviously not. That is another problem. Similarly, other factors. Okay, CAPM can vary depending upon the size of the company, because if a small company is there, it will be greatly hit by small change in the market. If it is a well-established company, it will be more stronger. Sir, COVID came. Tata's did not even reduce a single salary. They did not cut 10% also from a single salary of an employee. But if it is a startup company and COVID is there, will they be able to pay their employees' salaries? Obviously not. They'll go for salary cutting, or they may even fire the employees. So it depends upon the size of your company, and also the ratio of book value of equity to market value of equity. See, sir, this is again, what do I say? This shows the strength of your company. We call it as PE multiple, price earning multiple, if you know. Similarly, if the book value of your company's share, according to your books of accounts, if your share should be priced at $110, but actually your market price is $160, $170. Sir, why will it be like that? Because people are expecting growth for your company. They are ready to pay much more than the value of the share. They are saying that no, this company has a good potential, so I'm ready to pay a premium over the book value for this company. It shows the strength, isn't it? Even if your share should be priced at 100, we are paying 120, 130 to you. Why? Because we believe in your company. It shows strength. That means your beta is less. Even if market is crashing, we still believe in you. So you will have a lesser beta factor. But if your company's book value is 100, we are ready to pay only 101 or 102. If the market crashes, your assets will drop, your book value will drop, your share price also will drop, because you are not strong in the market. Okay, that is this. See, the ratio of book value of equity to the market value of equity, shares with book values that are close to their market values are more likely to fail, because people don't exactly believe in your company's stock. That is why they are not ready to pay any extra premium to you over and above your book value. So in that case, if the market is crashing, your share also will drop. Okay, so your beta is high usually. So that, my dear friends, is the entire discussion about how a portfolio distribution, diversification can reduce your overall risk. First thing, then we discussed about risk, beta, systematic risk, and unsystematic risk, CAPM model, and we just solved some sums using CAPM model as well. Okay, so with that, I'll wind up this lecture. See you soon in the next lecture. Until then, keep smiling. Take care. Bye bye.